So we move now to another very interesting topic, to venture capital. I have my friend Ari Björnsen. He's another young entrepreneur. His company is in Küsnacht. He used to work for UBS, for UBP before he founded his own company. He's advising in, guess what, alternative investments. And he brings to the table two very exciting persons from very exciting institutions. And Ari, the floor is yours.
Thank you, Alexander. We will have the panel broken down in three sessions. That is, apart from me introducing Björn and Victoria, we will give you a view into how the European VC landscape has changed over the last 20 years or so. And in regards to point 3, I expect your support, the support from the audience, to come with good questions. Now, with me on stage on one side, Björn Tremeri from EIF, and as Alexander has already said, it's the biggest allocator and investment advisor to VC. Björn, he is has various things on his plate, and he's amongst other oversees the European Angel Fund co-investment program and the Dutch Venture Initiatives program, as well as the program for Bavaria, all investment programs which are supporting the VC ecosystem in their local environment. On the other side, Victoria is dialing in from somewhere around the world, whether it's Asia or the US, we will find out a little bit later. But she's been in the business for a long time as well. Respectively, she founded TA Ventures, a venture fund in 2010, and with the TA Ventures, then later also founded the iClub, which has been mentioned before, which is basically targeted to provide institutional or qualified investors access to venture enterprises. So, basically, before I go that road, I wanted to say a few words on the venture market. Whereas, as we know, this market has developed and is developing very rapidly with technology advancing and so on. Respectively, there's also much need for venture ecosystem to grow and expand. And it is becoming very important for our economies and also for our well-being. For example, in regards to the transitions that we are going through, whether that's our goals for net zero or respectively the energy transition, very much is driven by the venture scene. And the venture scene, or the innovations, they are not coming anymore from the old economy anymore. That's to say, the blue chip companies, the listed companies which we know, they have deleveraged the venture or the innovation, the R&D to the venture ecosystem, and are more and more active on the M&A side instead. There are examples of companies, blue chip companies, they have acquired up to 100 companies in 1 year. That's how active they are on that part of the scene. So yeah, there is a lot of need for venture, a lot of need for innovation, for our economies to grow, companies to flourish, to basically hire people, to support or respectively increase money supply, and at the end of the day, they can only do that if they have access to finance. Now, looking at finance, looking at the European world and from the eyes of the OECD, here we have how the investments have developed over a time period of 15 years in the various European countries. Finland is more or less in the lead, or has been for a time. Respectively, Estonia is very close on their heels. But then again, Switzerland is also up there as one of the stronger player. And Switzerland, when looking at the overall OECD statistics, has moved quite a bit over the last 15 years, respectively from place 17 to place 10, which is very good progress. But when we move away from Europe and look at the OECD statistics from a more global perspective, we see that there are other geographies which are investing more into VC than we do here in Europe. And this may also explain, if you look at the US, how far the spread is between, so to say, the average European and the US. Then it may explain why US VCs have been more in focus in the past than European. There may be a good explanation behind it. Respectively, US government, they realized at a very early stage that entrepreneurship is of great importance for the country, importance in regards to help it grow, being competitive in the market. And they started their VC investment program, a strategic investment program for entrepreneurs in the early 50s. And that program has had its result. It has, so to say, had a spillover, or respectively gotten institutional investors active in the space as well, willing to look at it. They've seen this sector grow in the US in front of their house doors, and we're much faster in investing. Now, the US, they are investing about 2% of their GDP into VC. Switzerland, on the other hand, we have a lower number. It's at 0.08. But it's been growing, which is the positive news. But to put that in relation in regards to how the money is being spent or where the money is flowing, I believe from what I've read in the papers is that what the money that went from to support SBB in their infrastructure investments here in Switzerland was 0.7% of Swiss GDP. So I'm sure that many SME companies here in Switzerland will benefit from these investments. Local contractors in Aargau or Uri or wherever they are, which are helping building tracks or cleaning tracks or building tunnels, whatever they are doing, to make the transportation better in Switzerland. But just to put in relation, 0.7 to transportation versus 0.08 to support venture capital. And I believe it's not only in Switzerland, it's in many other countries, and this could be much, much more. If we look at the institutional investor landscape in Europe, and we pick out the biggest one, which is the pension funds in Europe. They manage trillions of assets and are the biggest institutional investor in its class. In Europe, 18% of the pension funds is on average invested in alternatives. Some countries a bit more, others less. But it's been the fastest growing asset class amongst others at the cost of liquid assets. So we see that there is a positive trend towards alternatives, even towards private equity or respectively non-listed equity, which on average in Europe accounts for 3%, and in comparison to Switzerland, Switzerland is at roughly half of that. Now, there are no specific figures that I found on venture capital, but assuming that these may be roughly 10% or a bit less, meaning that on a European average, investments from the pension fund system is only around 0.3%. And that's where we need a little bit more.
In the US, it's 5% to venture capital from the pension funds.
Thank you. And I'm coming to that because as we talked about earlier, or as I talked about earlier, the system that the US set up starting in the 50s, which has had a spillover effect onto the private sector, is seen here, for example, in these two examples. The endowment fund of the University of Michigan, they have had an equal allocation between VC and PE over the last years. And actually from the latest annual report, they have put it into non-listed equities, that is PE, VC, which today is over 40% of their asset allocation. On the other side, we have the Californian Public Pension Fund. They've been investing in VC for 30 years. They have just recently increased their allocation to unlisted equity from 8 to 13. And recently they hired Bill to head their VC investments and given him the challenging task to allocate $1 billion per annum over the next 5 years. These are just headlines that you come across when you Google VC in relation to institutional investors in the US. But US investors or institutional investors are not alone. Although the average allocation on a European average is low, there are exceptions, like Keva, looking up north, a Finnish pension fund. They have over 18% allocated to non-listed equity. Non-listed equity has been the best performing asset class in their portfolios for years. With the exception of last year, 2022, it was the second best asset class. It came out with a plus of 3.1 versus, for example, listed equities, 11.4 in minus. That's where we talk about, as before, the correlation, or respectively the alpha, that the private sector is bringing into this equation. So there are exceptions to the rules. There are pension funds in Europe which allocate to venture capital or unlisted equities. And as we see here, the trend is positive. Now that's the positive outcome. We have seen increased investments going into venture capital over the last years. Even 2022, despite being a difficult year, it was a good year compared to, the 10-year average in the past, both from deal volume flow, from everything, even from a valuation point of view for LPs. Very attractive development there. But when we look at the investor landscape who are allocating into the VC segment, we have the family offices, often investing into sectors from their origin, respectively the corporates, again, looking for innovation, looking for companies that can help them with their next product, or respectively in their own energy transition. And then again, also, we have fund of funds, which many institutional investors are also allocating to get access to a diversified portfolio of venture capital. Pension funds, they are still, so to say, evaluating, shall we or shall we not? Often it starts as a local play before they start widening their investment into the international space. But with that said, I want to give the floor to Björn, and I expect him to enlighten us why people have increased investments into VC in here in Europe over the last years. So thank you for that.
Good afternoon, everybody. I'm Bjorn Tremmery. I'm responsible for technology investments at the European Investment Fund. I've been there for 20 years, joined as a victim of the dot-com crisis, was working for a listed private equity fund that didn't survive being listed and being active in venture capital at the time of the dot-com crisis, but it was a good learning to see how to select good managers that are active in venture capital. For those not familiar with the European Investment Fund, a little overview slide. We're the largest investor in innovation and entrepreneurship in Europe. We don't invest directly. We operate under a fund-of-fund model to have scale. We typically invest anywhere between 3 to 3.5 billion per year in European venture capital funds, so not the 100 billion that Alexander said, but it's meaningful amounts. For the European continent. It makes us by far the largest allocator. We've been doing this for over 25 years. I think we were there at the birth of really the venture capital ecosystem in Europe in the early 90s. So we have history, we have experience to talk about it. We're also AAA rated by all major rating agencies, which is not necessarily relevant for our private equity activities, but we're also having a guarantee business where we do securitizations, where we do guarantee to loan books of banks to incentivize them as well to take more risk when lending to innovative companies. And we've got an own equity of 7.4 billion, which is only 20% paid in, which means that we need to raise money from other sources. We typically raise from governments or from the European Union or from the European Investment Bank, which are our main shareholders. But since 5 or 6 years, we've also started on the back of interesting activities that we saw in European venture, also in European private equity, to raise money from institutional investors, to give them access to the best of the best out there. And I have a presentation on that later on in this session as well. But we have allocated, thanks to the monies from our mandators, over 35 billion to more than 1,100 private equity and venture capital funds, split equally between venture capital and private equity, roughly, both on amounts allocated and on the funds invested in. So a portfolio of more than 500 active VC funds out there. That gives us a bit of an overview to say actually what the market is looking like. Luckily, I'm not alone. We're a team of some 35 investment professionals on the venture side, another 20 on the private equity side. We've got an in-house legal team, a private equity risk team as well, and a compliance team, which is increasingly becoming relevant in a highly regulated environment. The investment expertise spans a whole spectrum of risk levels. We were set up as a policy instrument to support the emergence of a new sector, venture capital, which was nascent early 90s. It wasn't existing. Silicon Valley had 30, 40 years head start to us. So we needed to invest in first-time teams. We had mandates. We had a market developer role with mandates that were willing to take that risk when the private markets were not willing to take that risk. We also have a catalyst role, a market catalyst role, to support those managers that can attract some private money but still need governmental support as well to be out there and to raise their fund. And then increasingly, as the market matured, we've also adopted a market access provider role because, believe it or not, European venture, and I will demonstrate that in the next 10 or 15 minutes, has evolved into such a state of maturity that it's generating returns that are at par, if not better, with what you can get in Silicon Valley or in Asia. Many people seem to neglect that. Many pension funds, asset allocators still neglect that because they were burned by the dot-com crisis and think that everything that is happening venture capital-wise in Europe is just a money-losing exercise. You are wrong, and we will show that later on. So for those that now want to have access to the best of the best, oversubscribed in Europe, we have also developed a product that allows us to play a market access provider role. Like I said, the European market has matured. We've overcome the stress test of a number of crises, the global financial crisis after the dot-com crisis, but then also the COVID crisis. We actually thrived through the COVID crisis. And actually, even in the current turmoil of rising interest rates, of energy crisis, of a war in Europe again, European venture is actually holding up. It's holding up because we have expertise and we are mature. We have expert managers out there that know what it takes to build a globally active, competitive unicorn or lighthouse company. It wasn't like this before. When we started off early 90s, Europe was, venture capital-wise, a cold continent. What this heat map is going to show is where the monies that we have entrusted to the funds that we invested in, where their money has landed. So this is a map that shows the number of thousands of euros invested per square kilometer in Europe. So the first block, and it's a timeline, is 96, 99. You have one or the other spots, Dublin, London, Paris, and a little bit of Lisbon that is a little bit hotter than elsewhere. It's because we just had a couple of funds in the portfolio that were allocating money there. But as we started to exercise our activity, I need to go back if, yeah, this runs, you see that Europe is actually heating up. And it's not like the US, where most of the activity is concentrated in Silicon Valley. You have many hubs popping up, not only Paris and London, also Stockholm. You see Berlin coming out of nowhere in Germany as well, when Munich was historically the technology innovation hub. You see the southern periphery of Europe, the eastern periphery of Europe, also attracting a lot of money, the Nordics. So not a single place in Europe is actually the leading hub for innovation. So those that think I'll take a plane to London, like I do when I load up on US venture, I go to Silicon Valley and load up on venture there. You might end up in London and you miss out what's happening in Stockholm. You might miss out what's happening in Italy or in Portugal, of all places. Portugal has $6 to $7 billion companies now originating out of Portugal, a 10 million inhabitant country that was mostly known for tourism. So it's coming all over the place. One of our most successful companies, UiPath, a robotic processing automation company, came out of Romania before it flipped to the US and listed at 35-40 billion 2 or 3 years ago. Why is it that Europe became such an interesting place and such a hot place? I will demonstrate that with this, if the clicker works, with this flywheel. Nothing happens without people, without talent. What do I mean by talent? It's people that actually want to become an entrepreneur. They want to become an entrepreneur because they see that it can be successfully done. 20, 30 years ago, we didn't have the role models that showed it. Becoming an entrepreneur was a bit like a suicide mission. It was perceived as being, why would you leave Siemens to set up your own company when, yeah, that's only the American dream. You can only accomplish that in Silicon Valley. Luckily, we started having, thanks to the support of governments not ditching the innovation segment, we started to see that the funding gave this spark to some early unicorns. Take a Skype, take an Untitled Klarna. And those entrepreneurs, when they were successful, they didn't stop their activity. They didn't retire and sip pina coladas on the beach. No, they said, I'm good at this. I want to continue doing this. So either with the money they made, they reinvested that in a second venture, or they became a business angel. And they put their expertise at work to provide more scale and to share their know-how with a larger portfolio of entrepreneurs. And that actually is a flywheel or a snowball that starts spinning faster and faster, or that becomes bigger and bigger. This success breeding success. And every city where you have a lighthouse company popping up gives birth to this ecosystem. And then if you have all this money in these hubs available, it means that each good idea gets funded. And I insist on good idea because at the dot-com crisis, it was sufficient to have an idea on a napkin with .com and you got funded. No, it has to be a good idea. But all that money now is there to support good ideas. Anybody telling you they cannot find the money for an early stage initiative in Europe and only can go to the US, it's because they want to go to the US. It's a lifestyle decision, not a money-driven decision. And these lighthouse companies or unicorns, we're giving birth to them at an ever-increasing speed in Europe. So that's also a very comforting data point. Even in 22, we are still seeing the second steepest slope of unicorn birth in Europe. And each unicorn, as I already said, is actually a founder factory, because the unicorns, they give rise to further entrepreneurship. Here you see per major city in Europe how many unicorns have been created there and how many additional startup companies have been coming out of this unicorn ecosystem, be it from the founder level, be it from the first employee level, people making money through stock options, people making money through good salaries at the beginning, or good ownership stakes in the companies. And most of them actually set up their company in the city where the unicorn that they worked for, that they founded, was initially founded. So that's how this ecosystem of hubs is actually happening. And we're not only good in Europe anymore in selling shoes over the internet, the e-commerce or digitalization, gaming. We've been big in gaming. Most games have been coming out of Europe. Minecraft is European. Clash of Clans is European. Angry Birds is European. It's all European, but we have not marketed that well enough. It gets still bought by the Americans, but it's coming out of Europe. Music as well, Shazam, Spotify. Spotify is still a far better product than Apple Music. Apple Music has $1 trillion market cap and can still not build a better product than Spotify. It's because we now have the execution skills as well. Increasingly, you see that the sectors where these unicorns in Europe are active in are shying away from e-commerce and more into real innovation, deep tech, into climate and sustainability as well, in fintech. So Europe is becoming relevant at global scale, industry-wise as well. We're not a continent to be ignored. It's not about overtaking. It's about being relevant. Also build your own sovereignty and your own autonomy. Not being dependent anymore, hopefully in the near future, of only sending your satellites into space via SpaceX or via the Russians or the Chinese, but also build your own infrastructure. We used to have Ariane, but look at the market share of Ariane, it just collapsed. So interesting developments that we see in Europe as well, sector-wise. Another element that happened is the ambition level of European entrepreneurs. They're not satisfied anymore to build a local champion. They want to build global relevant companies. How best to demonstrate that? By showing you logos of companies that in one round raised 100 million euros or more. A slide full. I stopped tracking them at 21, 22 because in 21 and 22 I could put the whole slide full of logos of companies that in one round raised $100 million or 100 million euros. You don't raise 100 million euros to become the number one in Germany or France or even in Europe. You want to have that financing capacity to be globally competitive with your Asian peers, with your Asian and US peers. So the ambition level has gone up, and that creates then even bigger companies. And if you create successful, good companies coming out of Europe, the returns need to follow, and they do follow. I apologize to the professor. This is by net IRR. It's perhaps not the best metric. In the second presentation, I'll also show some multiple data points as well. But if we rank our top 50 funds top down by net IRR amongst the 500 plus funds in our portfolio, the top 50 generates anywhere between 35% plus net IRR and 1,000 plus net IRR. That's the type of performance that many allocators still say, not good enough. I don't know where you find, because people don't allocate money to European venture enough as they should. That's the money that you leave on the table. Now, we all know that venture capital performance is like wine. You need to work with vintage years. This is a complex slide, and it's actually per vintage year, we're giving you the quartiles. So you have 3 data points per vintage year. The upper mark here, I don't know whether it's this is the upper quartile cutoff point. It is not the performance of the upper quartile. It means that 25% of all funds raised in 98 have a performance above 5%. That is the median, the middle mark. It means that 50% of all funds raised in 98 have a performance above minus 2.5%. And then 25%, the bottom quartile, of all funds raised in 98 have a performance below minus 12.5%. So, with that explanation, let's look at how the top quartile, because we all want to be in the top quartile, how that evolved. In the early days of European venture, in order to be top quartile between 98 and 2002, depending on the vintage years, it was sufficient to perform anywhere above 0% in 2000 or above 5% in 98, to be in the top 25% of all funds raised in that vintage. Now, that is not very attractive. Here I would say, stay away from European venture because you're not going to get a risk-adjusted rate of return. That's when the governments needed to stay in and support the segment, because you cannot ditch innovation. Innovation is the future. Luckily, things got better. Between 2003 and the global financial crisis, in order to be top quartile, you needed to be performing above 5% plus in 2004 or 5 it is, and above 12% in 2007. Above. So the band is the band where you need to be performing above in order to be in the top quartile. But then since we matured, since this flywheel started spinning, since the global financial crisis, in order to be top quartile, you need to be performing above 15 to 20%. In 2016, if you're not delivering 30% net IRR, you're not top quartile. There are more than 60 funds that we have invested in 2016, which means that there are more than 15 funds in 2016 that have a net IRR above 30%. So that's the level of performance that European venture is now bringing.
Björn, can you explain why the last 2-3 years are down? Some people may not be aware of it.
Well, there's a J-curve effect as well. So once you start investing, you first incur costs. And when you invest in a company, the first year is difficult to create a lot of value. So it takes a bit longer time. Nevertheless, 2020 and 2021 were the peak of what we will see an upcycle of close to 10 years. So even we had a little bit of a déjà vu with the dot-com, where you invested in 99 and in 2000 you could exit for 2 or 3 times your money already. Now, these are funds that have just raised and they have incurred more costs. Yeah.
Can we Victoria now?
Sorry?
Can we start with Victoria and also like you can have a bit of interplay between the two?
Yeah, I still have 2 or 3 slides that I would like to finish.
Can you finish them later? Can you start with Victoria now? So that we can, because otherwise we will not have time.
Okay. Okay, good. Here? There's really only 2, because otherwise, I know we're running late, but I was given a late start myself.
Go on.
So, sorry, Alexander, but otherwise, I can as well just skip the rest. Now, there's people saying, Bjorn, you forget 22 because there's a crisis going on and you're not showing it. It's not meaningful, but as to the crisis, let's look at what the former Intel CEO, Andy Grove, says as well. The impact of a crisis on companies. Bad companies are killed by a crisis. How can we disagree with Darwin? If you're not a good company, just make space for new ones. It's spring, we just celebrated the bug. How do you say that in German? Ich vertikutiere mein Rasen auch. So you need to separate chaff from the wheat. So then good companies will survive the crisis. So that's a positive message. So that's if you're good, you're not going to disappear. But what's important, great companies are going to get better and improved by them. And that's the real important message here. 25 years ago, we didn't know whether Europe had great companies. Now we do, and they're going to be improved by crises. Very quickly, similar slide, because I'm so frustrated with pension funds saying that European venture is a loss-making industry. So let's look at the numbers again. Net IRR, you want to make a loss, you need to be performing below 0% net IRR. So those pension funds that say that European venture is a loss-making industry, they must have worked really, really hard to select the bottom 25% of managers out there. Because honestly, you take a dart and you throw the dart at the European universe of venture capital funds out there, and 75%, the top 75% of any vintage but 4 you're in positive territory. So those making losses on European venture, you really made it an effort. You worked hard to find them. Now, of course, it's not about avoiding the losses, but it's difficult to make a loss on European venture if you build your portfolio. It's all about selection skills to maximize the return. Emerging managers perform as well. I'll skip this to the benefit of the rest of the session. The numbers are still up in 22 compared to 2020-21, so it's more a correction than a downturn. Even the initial quarter of 23 is not telling us that we're going back to 2017, 2018, or 2019 numbers, so it's still in positive territory. And market sentiment is something strange. I never understand people. When we're at the peak of the market, everybody wants to buy. You all know this. Buy, 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 because we're becoming greedy. And when it's falling, you all want to sell, this denominator effect. We're all a bit sadomasochistic, no? Not only are prices going down, but then you're telling yourself, and now I need to sell. I still don't understand. Don't let greed drive your decisions. This is what pension funds do. European venture is risky, so I'm going to invest in 2 American banks. Silicon Valley Bank and Signature. This is Alecta, the largest Swedish pension fund. They said, you know what, we're going to exit Swedbank, we're going to exit Handelsbanken. We think we can get better returns in investing in the US in Silicon Valley Bank and Signature. Now, I was a supporter of Silicon Valley Bank. I don't want to, but this is what you want to do, putting 2 billion at work there? Well, it's not the first time we've been presenting this data on stage that European venture is performing. Had you put your 2 billion into European venture, would be 3 billion by now. No, now you need to write it off and you lost your job. And now again, don't let fear drive your decisions. Also now, ships are safe in harbor, but that's not what they're built for. Same for you, we're investors. Be disciplined. Don't have fear. Have faith in yourself and invest. It's a better investment environment now than the last 3 years. The prices are way better now than the last 10 years. So everybody was so happy the last 3 or 4 years, 2021, 22. Now the prices have come down by what? By 50% on SaaS companies, and you don't want to invest? Thank you. I'm sorry to...
Hi, Alexander. Hi, everybody. Hi from New York. Yeah, it's great to be in Zurich virtually. Next time, definitely, I will be live present with you. And thank you, Alexander, for putting this amazing event again. And Jordan for the amazing presentation and for everything EF is doing for development of European venture capital ecosystem. That's what we need. So I will start, right? I don't know how much time we have now, so I will try to fit in 30 minutes. So a couple of words about myself. I'm the founding partner of TA Ventures, the venture firm. I started in Ukraine, and now we are acting internationally, invested in more than 220 companies so far since 2010. We have 6 IPOs in our portfolio, 11 unicorns and 20 unicorns. And so first fund was basically the family office fund. I started with 40 million myself, invested within the first 5 years, and exited 46 million in cash in the next 5 years, and still have in my portfolio of 148 companies minus 65 exits. The last round valuation, like fair value of the remaining portfolio, which is growing with the 20 unicorns and still 2 IPOs not realized. You might know these companies, DeepL and SumUp, of more than 150 million. So we are way above 60% net IRR, which we are targeting with the first family office fund. And then in 21st, we started the first fund with the external LPs, friends, mostly our founders, friends from Europe, and angel investors, friends who were considering to invest, but they didn't know how. So we started the iClub, the Angels Club, with now more than 500 members in 16 countries and 17 clubs, and growing to 25 clubs till the end of this year. And growing. So majority of our members are former CIS crowd living in different locations, mostly Ukrainians, and they are actively investing. We have more than 200 members which are investing more than 3 companies per year alongside TA Ventures. So that is our statement and mission to democratize the venture capital asset class for entrepreneurs and for those who are interested in this venture asset class. So I would like to give you some overview of our TA Ventures portfolio, and in our portfolio, just to present how the trends were shifting since 2010 when I started TA Ventures with my amazing team. Yeah, so now it's wrong to say that there are no money in venture capital. There are a lot of money. Still, the venture capital raised less than it was in previous years, clearly. The valuations are changing, especially in the growth stage. That's why, as a TA Ventures, we would like to stay venture. And please, next slide. We would like to stay venture and to do only pre-seed and seed investments. The target is to do 50 companies per year. Our geographical split is US, 40% US, 40% Europe, mostly DACH and South Europe, in Spain and Italy, and 10% in Latin America, Brazil, Mexico, and 10% in Southeast Asia, so Vietnam, India. So before, in my previous venture, I had 16 companies in India and successfully exited majority of them. Actually, we had also the first acquisition of Facebook in India. That was my portfolio company, Little Labs, back in 2012. Yeah, so let's go to the next slide. So it's easy to go to next one. It's easy to get into the venture capital. The money in VC is growing 10x in 10 years. What we need is the expertise, and we need to be an expert here. And we have in our portfolio of 220 plus companies, more than 3,000 experts currently. And our network is more than 30,000 active contacts. So we are helping our startups from pre-seed stage to Series A. We are not lead investor. Our strategy actually is similar to Tiny VC. I am sure you know this successful venture company, active from London and focusing on Europe. Right, and also in US, there is a company, a venture firm or lab. Now it's a fund, and they have multiple funds, FJ Labs, with more than almost 2,000 investments so far. So we are learning from them. So the system is the same. We are not lead investor, but we are the first or second co-investor, active first or second co-investor. Yeah. So the team, in order to be able to digest 5,000 companies per year, we are screening that many companies per year to select 50 per year to invest. I mean, the whole our team, if you can go back please to our team slide. So the team is distributed between Europe and US mostly. So Evelyn is American. She's in Boston. She was 3 years the director of Techstars Boston. Pavel is German. He's based in Frankfurt. Actually, he was speaking at the event you are present now several years ago together with me. Oleg is based between Barcelona and Los Angeles, focusing on Europe and US, and myself. I'm distributed between 3 geographies, mostly in the US, 4 months in US, 4 months in Europe, between DACH and South Europe, and 4 months in Asia. Mostly in Asia, but also Vietnam and India, so where we are refocusing our 10% of investments currently. So next slide, please. So these are our companies we invested so far. As I said, we reached 6 IPOs, and we have already 11 unicorns and still 20 unicorns in our portfolio. We are extremely proud of, and these are the company we invested at early stage. I mean, the whole team is we are all ex-entrepreneurs focused on helping and driving this venture stage of the companies to the best possible results. And it's actually materializing. So that's why we live, all of us, in the plane. We meet constantly with the companies. We don't do the mistakes of our previous first venture when I invested just my personal money as a family office, and I've lost about 30 companies, but I have not seen majority of them. That was a huge mistake and huge learning from the first venture. So that's why we're everywhere, meeting the companies in their places where they are, not in the fancy restaurants, etc. That's the business. So I would like to show you on the example of our portfolio how the trends were changing since 2010. Next slide, please. So that's how the trends. Next one. That's how the trends look like in 2010. Next slide. That is how the trends evolutionized in 2015. So you see which verticals have changed. It's like the DNA sequencing, clean energy, SaaS models, and AI, ML, which is basically everywhere in the majority of the verticals we are investing. And the next slide is 2022. I mean, the trends which were hit hard in 2022, and we can talk a lot about that, why that happened, etc. But these are all learning curves of venture capital per se. And then the trends of 2023, that's where we are investing now. So what we are seeing is the hard trends and interesting opportunities with the proven models, and something new also appearing in those trends I mentioned in this slide. Yeah, so just to wrap up on the trends and verticals. So as a fund, as a TA venture, so we are mostly investing in the following trends now: digital health, in biotech. This is major trends for us. In deep tech, under the deep tech, we have several verticals which are really interesting for the whole team and for our venture ecosystem and for business development on a global scale. It's robotic software, it's infrastructure optimization software, it's cybersecurity, and we're still considering fintech because the market is still open, especially in Latin America and Southeast Asia. There are a lot of opportunities to extrapolate our models proven in US and Europe to those geographies where we're exploring our business and searching for startups. Alongside the TA ventures, basically being the GP myself, and in each fund I'm putting myself as a GP commitment at minimum 25% and more. The first fund, as I said, it was 100% my personal GP commitment, my family investment. And the second fund, I put 60%. And from now on, we started to raise funds more often, basically building the pace of funding, having the funds every 1.5 to 2 years, 20, 30 million, or to pre-seed and seed 50 companies. 50% of them pre-seed and 50% seed. So now let's move on with the trends. And so I will explain a little bit more about the trends which are mirroring our investments. And you can see down at each slide, these are the companies from our portfolio which illustrate this specific trend. So the way how we live offline, right? So changed dramatically. So we have in our portfolio companies will be soon unicorn, another it will be 12th unicorn, I'm sure already in 1 quarter, but by the end of this year. The Gropius basically build the product. It's the approach is similar to Tesla for construction. So it's based on the technology of the engineer Gropius. We have the robotic factory close to Frankfurt, which can produce 250,000 square meters per year, and the capacity can be increased, full robotics. They work with the research institutes, more than 20 of them. and they can build this building. There is in Köln already close to Köln, the building 9-floor buildings. It can be built in 1 month actually, and the beauty is that the product is fully compliant with the climate rules, and it's
Victoria, can you hear
CO2.
me? Victoria,
Yes,
can you hear me?
yes.
Due to the timeline that we are pursuing, I would like to already ask audience to prepare questions. We will take 1 or 2 questions, and then I think we will wrap it up and go into the break. But it was extremely exciting so far already. Thanks a lot.
Okay, so a couple more minutes, right? Okay, so just
a couple of 50 remaining slides. I like
a couple,
approach.
just really quick, just super quick, just for the audience to understand the trends. So regarding the online, it's more than clear that Web3 is a big trend also now. Cybersecurity with a 2 trillion market is a huge trend also to watch. Also the remote work, the majority of the US and European companies agreed to move on remote now. So this is another huge trend, how we work on remote. Then the way how we eat, all these green gases emission, and the production of new proteins. This is a huge trend. Also sustainable proteins, lab grown meat, lab grown milk, etc. Another huge trend, healthcare, where we are betting 18% US is spending from their GDP on healthcare, and Europe 10%. So that's another big trend. Personalization of drugs, we're investing heavily in this biotech sector as well. Mental health, like almost 50% of the people are suffering from their mental health and disorders, different type of disorders, and we heavily considering this trend is a huge one in the next like 10 years at the minimum. Like shopping, our shopping techniques change completely. The 70% of the consumer, they want to switch to the sustainable brands, and that's where we're betting. Just imagine the 60% of the clothes are disposed every year. So this is a huge trend for the second life of clothes, and the new type of clothes based on lab-grown material, like Attitude. For example, the bamboo brand we have in our portfolio, like Shift, which is using 20% of lab-grown wool in their portfolio. Another big trend is also the asset management and fintech. Just 9% of the penetration of neobanks in Europe gives the door open for that mega trend. And what else? I mean, also the biotechnologies, aging reversal is huge. Gene sequencing was $1 billion 20 years ago. Now it's 1K only. In vitro fertilization, more than 200 million people infertile, and it's 50% female and males. And we are investing also heavily in this sector. We have 2 companies already and keep looking, etc. So robotics, as I said, I mean, robotic software, this is a huge trend. Space tech, but space logistics mostly. I mean, something which we can start using now and not wait like 10 or 20 or 30 years or whatsoever. And generally the climate tech is a big trend. Climate tech, solar, wind power prices like down 80%. That makes sense to consider this trend as a huge one in the future. Yeah, so that's basically all from my side. But just to sum up, I mean, we have to understand that all the businesses in venture capital are focused to optimize our life, to make our life easier, quicker, to access their services as quick as possible, cheaper, and make our life more transparent. So that's all about venture, and thank you so much. And please consider this venture asset class. It's definitely worth investing. Thank you.
Thank you.
Actually, sorry, I take over. I think what I really like about this panel that you put together, thank you very much, Ari, is that we have 2 completely different approach, right? We have this institutional approach, like steered by the European Union and like a power strike to really create a big institution. And then we have like an entrepreneurial spirit of Victoria that creates like some really big universe of investments just by entrepreneurial spirit. And I think that's really great to see the 2 different approaches, and they're both very important. So with this, I would like to take 1 question. Super. So please ask your question.
Question to Björn. What is your recommendation, given your experience, for Swiss pension funds to enter the venture capital space? What are the options and the do's and don'ts?
Well, it depends. Mic on?
Yep.
It depends on how serious you are about it, and serious doesn't mean that you're not serious, but how serious you want to implement it. If you want to build it in-house, you need to invest in a strong enough team and have patience as well. It's easy to invest, as Victoria said, but you need to wait long term for the results to come out. So you typically need to wait 6-7 years to get to your break-even point, the money that you invested, to get it back. And then after years 6, 7, 8, you're gonna start going towards the 2 times, 3 times return that we see even on a fund-of-fund model. If you don't have the capacity to build it in-house, there are plenty of people out there that can build and advise you to build such a portfolio. We do it ourselves on the venture capital side because we pride ourselves to be one of the few people that understand European venture. So if you want to enter European venture, you can speak to us. We can build SMEs. We can have our own fund-of-fund programs that can give you access to return maximization on European venture. There's other people out there as well that can build it in private equity, that can build it in other asset classes. But for you as a pension fund, you need to decide whether you're going to build it in-house or whether you're going to team up with an advisor.
Super. With that, we are ready for the break. I thank you. Actually, sorry for a little bit taking over. Sorry. Thanks a lot for the whole panel. This was really inspiring. Please enjoy your break and come back in 25 minutes at 16:30.